Hey, it's Dan Morales. This is Homebuyer Radio, episode number 166, or at least I believe it's episode number 166. It is possible it is not. Anyways, I've been doing a series on the 4 C's of credit, and the 4 C's of credit being cash, credit, collateral, and capacity. We just talked about cash, credit, and capacity. Got to remember which ones I've done, right? And this week we're going to talk about collateral. And now collateral, of course, is going to be the house that you're buying. And the house you're buying is, if you will, what serves as, if you will, our security for the mortgage. Meaning that if you don't repay your mortgage, we are going to foreclose against you, take your house back, and we're going to sell it. Okay? And so that collateral that we have is kind of what we get the ability to repossess, or, if you will, foreclose against in return for you not making your mortgage payments. Now, ideally, if we've done our job well, we hopefully put you into the position where you are able to buy a house and sustain that house. Now, I understand that things happen in life, and there are times where, unfortunately, a client may lose a property, because of different circumstances in life, and, unfortunately, that does happen sometimes. What we try to do is we try to make sure that we've put together a mortgage that is one that is sustainable for you, and that you have the ability to be able to be successful in that mortgage long term. Well, a bank is still going to look at collateral, and they're going to evaluate that collateral because they want to make sure that what they're lending on is worth what you're paying for it, and that if they had to take it back and they had to liquidate it in the open market, that it's reasonable that they could get their money back when it's all said and done. Well, how do we evaluate collateral? Now, the most common way that collateral is evaluated is by an appraisal. And an appraisal would be where the appraiser goes out, and the appraiser, typically would inspect the house and make sure that the house is worth what you're paying for. Well, how does the appraiser establish a value for a property? Well, how an appraiser establishes a value, and this would actually be a great future episode. I've got a couple of good appraiser friends that maybe we'll bring them on, and we'll talk about an appraisal and what an appraiser looks at. But how an appraiser establishes value is the appraiser is going to look for 3 similar properties that are similar to the one that you're buying, that are generally in the, kind of immediate same geographic area. They're going to look for 3 recent sales, typically within the last 3 to 6 months, of properties that are similar to your property. They're also going to look at properties that are listed on the market as well too, but those don't get quite as much weight as the ones that have recently sold. What they're going to look for is they're going to look for 3 properties that are similar. And now typically what an appraiser should do when they can is they try to bracket those 3 properties, meaning that they typically will find one of those properties that have sold in your general neck of the woods that it sold for maybe a little bit less than yours, but maybe it's a little bit less house, meaning that maybe it's a little bit smaller. It's maybe not, quite as big as far as square footage, but it's similar in overall, if you will, design and, if you will, appeal and marketability. Then they're going to usually try to find one that's a little bit bigger. It's a little bit nicer than yours. And then they're going to try to find one that's as close to being on the money as yours. And that's what's called bracketing. Okay, so the appraiser tries to bracket when possible. Easier said than done, okay? So just depends on what the comps are in a neighborhood. But the appraiser is going to go through, they're going to look for typically, similar types of properties that have recently sold within that last 3 to 6 months. And then they're going to make adjustments, okay? And those adjustments are for differences from your property to those properties. And so what they do is they start with what that property sold for, and then they're going to make a series of adjustments, and then they're going to come up with what's called an adjusted value, okay? They're going to take those 3 adjusted values, and depending on the differences in a number of factors, they're going to come up with, what's a market value for the house that you're buying. Now, that market value, ideally, is equal to what you're paying for. Okay, so in the case of, let's say you bought a house for $200,000, ideally, the appraiser is going to come back, ideally, with a value of $200,000 or more. Okay, now when a bank figures the, equity position or the amount that they're going to lend you, they typically are working off of the lower of the purchase price or the appraised value. Okay, so in the case of, let's say you bought a house for $200,000 and the house appraised for $210,000. When the bank figures equity position, we're working off the lower of the two. So in that case, the lower of the two would be the $200,000 sales price. So if you were doing, let's say, a 5% down payment on a $200,000 house, your 5% down payment is $10,000, which means you would finance $190,000 when it's all said and done. Well, we will, if you will, lend you, in that example, 95% of the lower of the purchase price or appraised value. Well, purchase price was $200,000, appraised value is $210,000. We will lend you 95% of the $200,000. Now let's take a different example. Let's say $200,000 purchase price, but now maybe the house only appraised for $190,000. Maybe you got in a bidding war and you paid more than what the market value of the property was. Actually, let's use a different example. This will probably make more sense. So let's just say that same house you bought for $200,000 and the appraisal was $210,000. We lend you 95% of the $200,000. Okay. Let's just say that same house was listed for $200,000 and you bought it for $210,000 because you got in a bidding war with 3 other people. And the appraiser goes out and the appraiser does an appraisal on that property, and the appraiser says, hey, this house that you bought for $210,000 is only worth $200,000, not that $210,000 that you agreed to pay for it. Well, if you're doing a 5% down payment, we are going to lend you 95% of the lower of the purchase price or appraised value. In this case, your purchase price was $210,000, but it appraised for $200,000, which means we're only going to lend you 95% of the $200,000, which is $190,000. Now, you could try to renegotiate the terms of the contract, and potentially the seller may be willing to do that. Maybe they aren't. Depends on how viable it is to remarket the property and get an offer that would get them still to that $210,000. Well, if you were in a multiple offer situation, it's possible that they could probably resell the house for comparable dollars when it's all said and done. Well, let's say that you have that $200,000 appraisal. We lend you $190,000. And let's just say the seller says, hey, I'm not selling it for anything less than $210,000. I'll still do the deal, but you're paying me $210,000. Okay. What that means is you get to pay the difference between the appraisal and the purchase price, which is $10,000, plus the difference between the loan amount and the appraised value. So in that scenario, you can still proceed forward with that transaction, but you're putting $20,000 into the deal, not $10,000. So just know that appraisal can have a big impact when it's all said and done. Bank's always going to lend on the lower of, if you will, purchase price or appraised value. Now let's take that same example. Let's just say we have a $200,000 appraisal. We bought the house for $210,000, but let's just say that you were going to put $50,000 down when it's all said and done, and you were only going to finance, $160,000 of that $210,000. You can still move, that deal could still move forward even though the appraisal was $200,000. Now, when we figure your equity position, we're going to figure your equity position based on the lower of purchase price or appraised value. So in that case, we would have a, if you will, mortgage amount of $160,000 against an appraised value of $200,000 against a purchase price of $210,000. That, if you will, $160,000 is 80% of the $200,000 appraisal. You still have a transaction that's very doable. You just would have to have the peace of mind that you paid $210,000 for a property that was appraised for $200,000. But that transaction could go forward, irregardless of whether or not you tried to renegotiate the sales price. That transaction is still doable. So if a client has enough of a down payment, the fact that the appraisal comes in low, not necessarily a big deal. It's just you'd have to be, like I said, you'd have to be comfortable with the fact that you're paying more than what the property appraised for. If you're doing a minimum small down payment, that can be an issue. Now, this is where it all kind of comes together. Let's go talk about that cash portion of the 4 C's. Maybe you're doing a minimum down payment as part of what you're doing. And as part of that minimum down payment, maybe a part of your offer had you negotiate some seller paid closing costs. So, maybe, one of the reasons that you ended up at that 210, let's say, versus, 200, it was because you tried to, negotiate to have some, you outbid somebody else and you try to build some, if you will, seller paid closing cost in as part of the transaction. A lot of times sellers can be hesitant to take an offer where you have seller paid closing cost because they may have some concerns about the appraisal, right? So let's just say you bought the house for $200,000 and you had, $210,000 as your contract. You bought the house for $210,000 and it appraised for $200,000. hard. Well, you might have some sellers who say, well, I'm not willing to take your offer of 210 because, you had seller paid costs and other stuff built into that number. And I'm afraid that, I might have an issue with the appraisal where maybe somebody else offered less and they didn't have those things kind of built into the sales price. The seller's always going to look at, well, what's my net when it's all said and done? I could have one person that had an offer of 210, but they wanted $10,000 in concessions, which means really the seller got, let's say, 200,000 versus an offer that was just for 200,000 with no concessions. Well, that 200,000 is a lower barrier to be able to hit for an appraisal, which means that you can have a seller that says, I'm going to take that offer just because the net to me is the same and I have less risk, let's say, in maybe having an appraisal issue. Now, that's not, that's really oversimplifying things because there are a number of other factors that can go into, what makes one offer successful over another. But just know that the appraisal is going to be a big part of this deal, right? Because whatever that appraiser ties that, the value to is really what, is going to drive what we're able to lend. If you're doing a minimal down payment, that's going to impact you. If you're doing a larger down payment, it may not be as big of a deal. Now, if you go back over the last number of weeks where we talked about, your cash that goes into the deal, and then we talked about, overall credit history, and then we talked about debt to income capacity, and now we're talking about collateral, you start to see how all of these pieces all intertwine and they all come together to be able to determine whether or not you're eligible for a mortgage or your mortgage gets done, right? So let's just say you had a really bad appraisal. Maybe and I guess the other part of talking about collateral is, is the house in disrepair? Does it, have, a bad roof? Does it have broken windows, paint that's chipped or peeling? Does it have, other, health and safety issues that could be a problem for the appraiser? If so, and you're trying to do a minimum down payment and you don't have a lot of, if you will, margin to fall back on because you don't have cash reserves and you have a high debt ratio and you have marginal credit and you got all of your money as a gift and then the house has a bunch of repairs that's necessary, what you have is probably a really good FHA loan. That's a really bad joke. But, that's, probably how that loan would get done if the property would meet FHA's minimum property standards, because that would be the other issue. But you can start to see how all of these pieces kind of intertwine and how they can all come back to having, difficulty of being able to get a loan approved. This is really where you need to have an experienced lender that knows what they're doing, that can tie those pieces together and can kind of help you navigate through all of this stuff. You're not going to get that on an app, right? Maybe you see all these, online lenders, well, apply here and click through here. And, you're going to deal with the guy who was a server at Applebee's, last week, and now he's your mortgage expert. And that guy is supposedly going to lead you through this whole process. Good luck. So, I don't mean to sound negative, but there is so much more to this process of buying a house and financing it. And so often people downplay the importance of having somebody who knows what they're doing and can navigate through the troubled waters of getting a mortgage. That's where somebody like me who's done this for far too long, who knows what they're doing, is a huge asset to you when you're getting ready to buy a house. Hey, I'm Dan Morales, America's Mortgage Man. My NMLS number is 709729. My phone number is 616-931-4629. You can find me online at danmorales.com, DANMORALEZ.com. And of course, North Point Bank is an equal housing lender. Thanks for listening. Hope you have a great day. Bye.